Hey, Dan Passarelli here. How are you feeling today? Hope you're feeling great. I'm feeling great. Before we get started, I want to make sure you can hear me. You know what to do. Hit it. Q&A box, baby. Thank you, Justin. Thank you, Gene. All right. Today, we're going to talk about what I like to call the Vega trap. How option volatility can make or break your directional trades. This is such an underrated thing. I'm glad we're having the opportunity to talk about this today. Now, before we get started, I need to point out options are not for everyone. You should read characteristics and risks of standardized options before trading. You can get a copy of that by emailing investor services at theocc.com. Don't trade with money you're not prepared to lose. And everything we're doing here is providing generalized information, not specific to your situation. I would like to take a minute to introduce myself to our new friends and family members here. I'm glad that you're here. So, my name is Dan Passarelli. I am an author of two of the most popular option trading books, pretty soon to be three, I hope, because I got my third one coming out in just about less than 3 months, which is pretty darn exciting if you ask me. And, I also write a lot of other stuff, including my Substack article for our paid subscribers. That is about a once a week article where I drill down a lot. There have been some moves happening in the market over the last couple of days. Obviously, some of that has to do with earnings, but some of it has to do with the new Federal Reserve Chair nominee that Trump just announced on Friday. And it's a whole regime shift. There's a lot of different stuff going on. As you notice, some crazy activity with gold and silver lately. I wrote an article explaining all that. So you could go to my Substack, which is Wealth Building with Options. So you can go to wealthbuildingwithoptions.substack.com or just search Wealth Building with Options or search for me, Dan Passarelli, on Substack. Those articles are for our paid subscribers, but I think you can do a free trial if I'm not mistaken. You can get like one freebie. This would be a good one to read. And it's like $30 a month too. So it's practically free. Okay. In addition to writing prolifically, some might say, I'm also a trader. I was a professional trader on the floor of the Chicago Board Options Exchange for a long time, then traded upstairs briefly, as they say, and now I trade in a retail trading account just like you. So I've been there and I've done that and I'm still doing it. And I have seen lots of different facets of the options trading world. And I share that experience with good folks like yourself. I have founded Market Taker Mentoring. I'm the founder, CEO, president, chief content creator at Market Taker Mentoring, which is the global leader in option trader education. We have students in over 50 countries, believe that or not. Over 50 countries. There's a couple of countries I never even heard of. And We've put tens of thousands of students through our trainings. I don't know how many, 20,000. I don't know. I don't know how many, but a lot. We've been around for 18 years. We know how to crank out solid traders. And I am an industry collaborator. I work with the good actors in this industry, including options friendly brokers, the good ones like Firstrade here. Yes, like Firstrade here. Um, as well as most, if not all, the exchanges globally that deal in options. Had some experience with them. Had a meeting in Hong Kong with the exchange there, in Shenzhen, uh, Shanghai. Where else? Obviously, New York, Chicago, Philly, all over, all over. And besides trading, the important thing to me is my family. Those of you who are in the Market Taker family and have signed up for some of our courses, or those of you who are all in and did the one-on-one coaching, first of all, great. But you know, my wife, Kathleen, who runs operations here at Market Taker, takes good care of, she does the white glove service as well when you're in our one-on-one coaching and you're really part of the nuclear family. Gene, you can email me. Actually, I'll tell you what. Here's what I'm going to do. I've actually got something you can fill out, an assessment.
Hey, Dan Passarelli here.
Oh, look at that. Just fill this out. Oops. Oh, crap. Hey, Gene, can you ask that question again? I was going to post you a link, but I hit the wrong button. Oh, there we go. I figured out how to do it. There you go. Just click that link and fill out the thing, and we'll have somebody give you a jingle. All right. You got the link, right, Gene? Awesome. So, yes. And I also have my two adult children who we just saw the other on Friday, which was great. We don't get to see them as much as we'd like to. I just texted with my son just a couple of minutes ago before I started this. Usually I don't hear from that often. I think it's a boy girl thing. Hear from my daughter all the time. My son, not as much, not as much as I'd like to. I try and call my mother as often as I can, but I should probably call her more too. And besides family, you can hear my two little squirt dogs. One thinks she's a Doberman, but she weighs 6 pounds. Oh, goodness. And other things to do for fun is I run. Although this morning it's too gosh darn cold outside, so I rode the bike in the house, which just feels terrible. I want to be outside and get fresh air. Why the heck do I live in Chicago in the winter? I don't know. I don't know. I don't know why. There's not a good reason for it. There's really not. And I'm a foodie. Love to eat and to cook and to go to restaurants. I just love that stuff. I eat it up. Haha. See what I did there? And I also enjoy traveling with my family and with John, who's our head coach here. We've been all over the country, to a lot of different parts of the world together, teaching options. And I'm a music person too. I spent a couple hours last night with the headphones on and just doing nothing but taking in sounds. But enough about me. Who cares about me? Who's the important person here? You are. You're here for a reason, and I'm excited about that. I'm going to give you some great information here today on what I call the Vega trap. But those of you who are the best of the best here have solid, lofty goals. You can go to our website, markettaker.com. You can click join free. But if you scroll to the bottom, by the way, then you can do what Gene just did here. I'll show you actually. This is our website. Pretty sharp, right? I believe I worked with all these media companies. Jeez Louise. You scroll to the bottom and you just click on one-on-one coaching, and there's like like an assessment there. There's a little video of me explaining the whole process. But yeah, that's good for those of you who are, really pumped up about making it happen and want to hit those goals and want to fast track it too. You learn a lot in these Firstrade webinars that I do every Tuesday. I hold nothing back. I drill down deep sometimes. Sometimes I keep it basic too for the newer folks, but I give you everything I can. But, I got a lot bouncing around up here when it comes to options. And so if you want to fast track it and not spend 2 years attending webinars, make it quicker. That's what one-on-one coaching's for. All right. So let's talk about the Vega trap. This is our agenda today. So let's just jump in, shall we? First of all, let's talk about being right. Sometimes you can be right, but you can be wrong. Have you ever done this? You forecast a stock to go up, whether that's a technical breakout or fundamental analysis or whatever it is, bounce off support. You think stock's going up, so you buy a call naturally. And you're right, the stock goes up, but you lose money on your call. How could that even happen? Well, it can, and it does. Being right isn't enough. You got to be right and position your option trades correctly. Do you know how many different types of options trades there are? You got your long call, you got your long put, you got your bull call spread, your bear call spread, your bull put spread, your bear put spread, your call condor, put condor, iron condor, call butterfly, put butterfly, iron butterfly, straddle, strangle, short straddle, short strangle. I don't know. I could keep going. Covered call, cash secured put. We're getting close to 20 here, and I know there's more that I didn't even mention. Ratios, spreads, back spreads. It's like 43 or something last I counted. And naked spreads, thank you. And then my friend at Tasty Trade, Jenny, ends up making up these new ones too. Jade Lizard, one called the Zebra or something. I don't know. I haven't looked into that one, but the Jade Lizard, I got one of those on right now. So let me ask you something. Do you know why there are all these different types of option spreads? You know why? Is it because the king of options decided from this day forth, there shall be now a new spread called the, I don't know what, green Garanimal? No, it's because, yes, Gene, thank you very much. Because there are many different market scenarios. It matters if you buy a call or buy a bull call spread or trade a back spread or sell a put or sell a bull put spread. All these are all bullish positions, but there is one that is right for whatever the specific situation is, the market scenario, as Gene says here, whatever that market scenario is. And that's very, very important and very, very underrated. As far as options pricing goes, let's talk about that. So when stocks rise, right, stock price goes up, call price goes up, put price goes down. When stocks fall, call price goes down, put price goes up, right? So that's easy. And that's one of the first things that people learn. Is that enough? Gosh, no. Because there's also time. As time passes, as each single day passes, both call prices and put prices go down. And that, friends, is probably the second thing that people learn. And then they, get into things like covered calls and cash geared puts and stuff. But this one is also information out there that some people learn, but maybe don't think enough about. And that is what we're talking about today. That is what is so important today. When volatility rises, call prices and put prices go up. When volatility falls, call prices and put prices fall. What the heck am I talking about here? Huh? Well, let's figure that out. What do we mean when I say volatility? Well, it's the old, I know it when I see it. Who was that was famous for saying that in the late 80s or early 90s? Was that Kitty Dukakis or something? You guys remember what I'm talking about? I don't want to go down this rabbit hole. This is a family show, but you remember that? I know it when I see it, which ended up being a really funny thing to say in the context that it was said. But, we kind of feel that way about volatility. Like, yeah, of course, I know what volatility is. When the charts are going whipping all over the joint, that's volatility. And yes, that's correct. But we as option traders, we have got to dial it in. We've got to put units on it and we've got to analyze it. And as far as the stock chart whipping all over the place, we can look at historical data, closing prices, actually, technically, daily returns, but I don't know how technical we have to be. And we can look at stock charts, right? So here's a chart. Prices are not current. It's a screenshot from several days ago, I think. A couple days ago. Not a recommendation, but what do we see here from a volatility standpoint? Is this volatile? Well, look, we look at this part of the chart and holy crap. I mean, the stocks, it's up, it's down, it's all over the place. You look at this part and we're kind of in more of a range. I mean, it's kind of a wide range, to be fair, about a 25% range, but it was very volatile 3 months ago or 6 months ago. And this past 6 months has been somewhat less volatile. This is what we call historical volatility. Okay. It is just simply a mathematical measure of the past volatility of the stock. I was part of a webinar once with Shelley Natenberg, who is just a giant in this industry for his work, especially with volatility. An early pioneer in it on many levels. His name is probably starting to be forgotten by now, but it shouldn't be. He wrote a book called Options, Pricing, and Volatility. Options, Pricing, and Volatility? I think that's what it's called. It's a good one. But he described historical volatility, which is what we're talking about, looking at a stock chart and see it's all over the joint, as backward looking, because you're just looking back. Oh, here's what that stock did in the past. And when you look at the stock chart, like if I want to say, well, how volatile is it? When I looked at the one, I said, well, it's down, it's up, it's all over the place. What does that mean? When I said for the low volatility, oh, it's in a range, probably about 25% range. Well, we are traders. We have to lean into that left brain. You need the right brain to be a trader too, but you have to lean into that left brain, that logical part of your existence. And the objective part of your existence. And so we need to put some numbers on it. And that number is annualized standard deviation. Okay. Oh, excuse me. We take the daily returns from the past month of closing prices, which I would say is 21 days, trading days, and find the standard deviation and then annualize that standard deviation to make that 1 month representative of a 1 year period so that we can compare this period to that period, this stock to that stock, this historical volatility to this implied volatility, which we'll talk about in a second. And everything's apples to apples. So that's how we measure the stock volatility or the historical volatility. Implied volatility is what Shelley Natenberg has, at least once during this webinar, described as forward looking. Now, there's a lot to that. A lot to that. I could talk for days about that. And I, if we're going to cover everything we need to cover today, I've got to condense that into about 1 minute. So forward looking, yes, kind of. People describe implied volatility as the expected future volatility embedded in an options price. But what it really is when implied volatility rises, options prices are rising. What I typed here is when implied volatility rises, so do option prices, which I want to be really clear. That kind of makes it seem like, well, if implied volatility rises, then the option price rises. But it's really the opposite. It's when option prices rise, all else held constant, that means implied volatility is rising. It's a subtle difference, but kind of important. Because implied volatility is derived from the market, from option prices. We take the options pricing model and we take the options pricing model and we use it to solve for implied volatility. People think that the options pricing model is designed to value an option, and I would argue that it's really not. The options pricing model is used to identify the implied volatility of the option. Implied volatility is sometimes more important than directional movement. Vega measures implied volatility's effect on option prices. I describe Vega as the great translator. It translates, hey, implied volatility moved this much. That means options prices move this much. Well, what's the exact relationship? Vega stands in the middle. Vega is the translator. Now, speaking of translator, let's give you a crash course in Greek. Delta, gamma, theta, and vega. So delta is a lot of times the primary thing that you're actually trading. You're trading the direction of the underlying stock. I mean, even if you're doing something like a credit spread or an iron condor or something, you're still putting on a position where the main contingency on your profit or loss is what the stock does. Delta matters. Now, delta might be zero in the beginning, but delta changes with gamma. And so gamma and delta are kind of linked together. Let's cover these things. So delta is an option price's sensitivity to a change in the underlying price. So what I mean by that, it's kind of like its own translator, right? If the underlying stock goes up by 47 cents, how much should the call go up? All else held constant, meaning not a week passes or anything like that. Just all of a sudden, stock goes up 47 cents. How much does the call go up? That is what delta measures. It measures directional sensitivity. And when options are in the money, they have big deltas. When options are out of the money, they have small deltas. And so we can take that concept and realize that that means as stock price changes and options get more in the money or less in the money or more out of the money or less out of the money, their deltas consequently must change. And gamma measures how much delta changes as the underlying stock price changes. That makes sense? Is that a good, for those of you who are pretty experienced with options, that pretty good definition of gamma? You learn by teaching. I remember when I was in college, I used to do Taekwondo, martial arts, right? That was back when I was in college. Now I run, both for exercise and if somebody wants to fight me, I run. I don't practice Taekwondo anymore. But I remember one time I came in, and this is when I was like a higher belt, you know, like a red belt or something, just about ready to get my black belt. And, you know, once you get to that level, you're like, you know, it's sort of like a pyramid, right? Like lots of people join as white belts and then some find it's not for them. The schedule gets busy. They drop out, you know, some get the yellow belt and the orange belt. They drop out. But, you know, fewer people with anything, even with option trading, right? There's fewer people that go on to become great traders because they don't put in the time and they don't put in the effort. So, you know, by this point, I was one of the experienced guys in the class. And there was a new person who joined his first day as a white belt. And I was, you know, I'm ready. I'm like, okay, you know, let's do this. I want to work out with the black belts, you know, really practice, learn some new stuff. And the master said, hey, Dan, listen, we got this new guy. I want you to teach him how to do a sidekick for the whole hour. And I was like, what the heck? Man, I am here to learn. I am here to, you know, like, isn't that your job to teach him? You know how it is when you're like 19 years old. You think you know everything. Wasn't it your job to teach him? I want to work out. I didn't say that to him, you know, but that's kind of what I thought. But turns out that even though I'd been at it for like 3 years or something like that, 4 years. I don't know how long it was, probably 3 years. I actually improved that kick because I had to break it down into little parts and explain it. You learn when you teach. And so, yeah, been explaining gamma for decades. And I think this is a pretty good definition. It's as options get more in or out of the money, their deltas change, and that's gamma. You distill things, you know? So when you own options, gamma is positive, which means it helps you. Either you're making money at an increasing rate or you're losing money at a decreasing rate. Either way, it's a benefit, right? Then we have theta. That's an option sensitivity to change in time to expiration. Long options, well, all options decay in value. And when you own an option and they decay in value, well, that's not good. That means you're losing money, right? But when you're short options and they decay in value, that's good because you want them to get worth less. And then finally, we have Vega. So Vega is an options sensitivity to volatility, specifically implied volatility, the volatility embedded in the price of an option. Is a very commonly overlooked risk. How does Vega play into directional trades? Well, if you have a directional trade, you have three primary risks: underlying price, time, and implied volatility. If you have a non-directional trade, you still have those same risks. I would argue that whenever you make an option trade, you're always trading this basket of exposure. Every option trade has exposure to the underlying price moving. Every option trade has exposure to time passing. And every option trade has exposure to implied volatility changing. And so you want to be good at option trading, you got to be good at the Greeks. So let's go through an example here. Let's say I'm long well, this is an old example. John was supposed to change this. John. Oh, John. Well, it doesn't matter if it's SPX, but let's just say a trader believes that this stock or index is going to rebound strongly in the near future. Specifically, believes this stock will rise sharply from its current value of 839 by June. And so the trader buys one June 840 call at 60. So what can go wrong? Well, one, the stock could go down. I could be wrong, right? Two, too much time can pass and I can lose more on time decay than I make on delta. Or three, implied volatility could fall. So let's say we're long one of these April 40 calls in whatever the stock is. The delta is 53. The theta is 40 cents, which means, well, first of all, what does 53 mean? That means that the call price moves 53% as much as the underlying price. And so if the stock goes up by $1, the call goes up by 53 cents. Theta, 40 cents. What does that mean? It means as 1 day passes, the call loses 40 cents. Vega, $1.60. What does that mean? Well, that means as implied volatility falls, the call loses $1. Well, if implied volatility goes up 1 point from 40 to 41, the call goes up by $1.60. If implied volatility goes down 1 point from 40 to 39, the call price goes down by 160. So let's say, hold on a second. One second. I just had to send a little note to John about our next class, which is going to be a great one. But I want to make sure it's going to be ready for you. Okay, so let's say the stock rises to 890 over 1 month. And wait, the stock was originally at what? What was the stock originally at? Oh, it doesn't say. Oh, 839. So if it goes up to 890, we have 890 minus 839 is 51 bucks. But the call has gone up by, what was the value of the call? I don't know what the value of the call was. But I made 1,900 bucks. If the price rises, I made 1,900 bucks on delta being positive and being correct, theta being wrong, losing on theta. But if the same thing happens, it goes up to 890 in 1 month, but implied volatility falls 15 points, which can happen. You look at most stocks or the market itself. If a stock goes down a lot, its implied volatility can go up a lot. But then if it rebounds and goes back up, its implied volatility is typically going to fall back down to earth. So if implied volatility falls 15 points, you can actually make money on delta. You're going to lose money on theta, but you're going to lose so much on Vega, implied volatility, that all your profit is gone. That is what I call the Vega trap, where you're right, but you're wrong. Observation after volatility change in scenario 2, which is, kind of a more realistic scenario. When stocks go up, for most stocks, when stocks go up, implied volatility goes down. That's a very common thing. That's true for about 80% of stocks. So we really need to pay attention to implied volatility in Vega on every single trade. I'm going to tell you a story. So this was a long time ago. I had a one-on-one coaching student, really, really nice woman. She was very smart. She was, gosh, an accountant or something like that. I don't know. I don't remember exactly what she did, but she understood numbers. She understood math. She understood stocks. She was good. And there was one day. Now, this is a long time ago, by the way. This was 16 years ago. This was 2010 or 11, 15 or 16 years ago. And I remember this vividly because it was when Apple announced the iPad. Oh my gosh, do you remember that? There are probably some of you who thought iPads always existed. Like cavemen were walking around with iPads, right? No, no. It's they were introduced somewhere around 2010 or 2011, as I recall. But before that announcement, around the time of that announcement, Apple had earnings coming out. And this one-on-one coaching student said, "Hey, Dan, listen, my son," she had an adult son who was like, 21 or something like that. Now, remember the story I told about Taekwondo. When you're 21, what do you know? Everything, right? Right. So she had a 21-year-old son, and she said, "Hey, listen, my son is a big like Apple buff, knows everything there is to know about Apple. Knows Steve Jobs' favorite color, what he ate for dinner last night, which is probably some sort of mung beans or something crazy like that. And he thinks that Apple is going to outperform on earnings, and he wants to know which calls are the best to buy." So I said, listen, Sally, her name wasn't Sally, but let's just give her a name. "Listen, Sally, here's what I want you to tell your son. Here's what you do. Forget this opportunity and take an options class." Now, that was just not good enough for this kid. And so she said, "Listen, he wants to send you an email. Is that okay?" I said, "Sure, you can send me an email." So he sent me an email with his thesis on Apple and why it was going to outperform on earnings. Now, by the way, it's pretty hard to determine what a stock is going to do on earnings, because even if it beats expectations, if it doesn't beat it enough, the stock can go down, because like it's something like almost 80% of stocks beat analyst expectations for earnings, like every quarter. That's a thing, which is kind of weird. Like you would think the analysts would get better, or they're just kind of playing some game and, always lowballing their numbers, which is probably more likely. But anyway, he gave me this big write-up. It was like a freaking novella. Like it was the longest email I ever read. And you know what? The kid knew about Apple. I mean, it all made perfect sense from a fundamental standpoint to a technical standpoint. And he was realistic. He said, "Look, I think there's a 60% chance of me being right, 15% chance that it'll overshoot and I'll be even more right, 20% chance or whatever of me being a little wrong, 10% chance of me being a lot wrong." Like it was a great, great analysis. But there was one thing missing from his analysis. And you know what that was? I bet you know where I'm going with this. Implied volatility analysis. You looked at the stock, but never looked at the options, but you're trading the options. What the stock does is only part of what happens to the options price. It's one out of three things. I mean, really, there's five things, but three major things. So I said, "Look, man, here's the thing. I would just really love to help you out. I mean, I bend over backwards for our one-on-one coaching students, and your mom's great. But here's the thing. I could give you the answer, but you're not going to know what to do with it if you don't fully understand how option pricing works and how implied volatility plays into it. And he just, he got frustrated with me and went and bought some at the money calls, or just out of the money calls, maybe. I don't remember. So that day, Apple stock went up $11. That's a pretty big move. You own some calls, you ought to make some money. And he did make money on Delta. But he lost money on Vega. When it was all said and done and the dust settled, when Apple was up $11, figure the delta of those calls was probably like 45. Guess how much money he made on those calls? Anybody want to venture a guess? Good. Hit the Q&A box. Anybody want to venture a guess on how much money he made on that trade? You buy calls, the stock is up $11. Yeah, Justin, exactly. He lost. Actually, he lost like just barely, almost broke even. But isn't that crazy? You buy calls, stock's up $11, and you lose money. Jumping Jesus on a pogo stick. How the heck does that happen? Well, it happens because, especially after earnings, the implied volatility crushes, is what they call it. And when implied volatility goes down that much, like you make money on Delta, but you lose money on Vega, and it's a wash. Technically, there's a day of theta in there too, but one day of theta doesn't matter that much. Let's just look at one more example here. So this is ABC Corp, the already been chewed bubblegum company. Will release its quarterly earnings figures tomorrow. Implied volatility for the at-the-money calls expiring in 3 weeks is 48, which is 25 points higher than usual. After studying financials, reading up on the company, trader Trisha believes ABC stock will rise sharply from its current value of $68 upon the earnings announcement. So she buys the 10 of the 70 strike calls at $2.45. So just like the Apple story, right? What are my risks? Well, the stock could go down. And it's just one day that she's planning on holding this trade. So theta is not really a super important thing, but implied volatility is. So she's got a delta of 43, a theta of 7 cents, and a Vega of 7 cents, incidentally. And the implied volatility is 45. So stock rises to 71 after earnings. And let's say implied volatility is unchanged. Well, she's going to kill it, right? She bought him at 245, sold him at 390. That's $1.45 a contract, which is $145 times 10 contracts is $1,450. Bing, bang, boom. But that's not realistic. After earnings, the volatility is going to crush. It's going to fall. And if and when it does, whatever she made on Delta, she's going to lose something on theta. And in this case, she loses more because of Vega. I think I said theta. She loses more because of Vega than she makes on Delta. Yeah, Gene, these are outright long contracts. Outright long. And you bring up a really good point, because one of the things that you can do in some of these scenarios, I mean, first of all, when it comes to earnings, I am in the camp that you cannot predict the direction of a stock after earnings. But yeah, Gene, you're absolutely on the right track. You can do some sort of spread, a poor man's covered call. Yep, absolutely. You can buy a call spread Why? Because when I buy options, I have positive exposure to implied volatility. If implied volatility goes down, gets crushed, which it will after earnings, usually, can't guarantee that, but almost always, then you will lose on that long option. But if you have a spread, then you're long one option and short one option. So you lose money on the one you're long, you make money on the one you're short. So yeah, like a poor man's covered call can be a great way to do it. I kind of prefer, well, first of all, I never pick direction on earnings. I have an earnings trading system, but it's a pure volatility play, not a directional based play, where you're capitalizing on the crush. So I don't bet on earnings. There is some evidence that if you always bet long on earnings, that you probably do okay. But, you know, you take a lot of lumps as well. I'm more of a fan of keeping them in the same expiration cycle instead of a poor man's covered call where you're buying a longer term one and selling a shorter term one, because otherwise you could get assigned on the short term call that's about to expire, and still have a long call that might have some time premium and you wouldn't be able to exercise. So then you end up long and in the money long-term call and short stock. Whereas if they're both in the same expiration cycle, then if that happens, your short call is in the money. Well, your long call is in the money too. So you get assigned on the short one, you exercise the long run, and boom, no stock, which is exactly what you kind of prefer. Okay, so there are some. Does that all make sense, by the way? Does that all make sense? Because there's lots of ways to deal with this, the Vega trap. The takeaway here isn't, well, you're just kind of screwed because you can lose money on, your Vega. So just don't trade options. No, that's not the takeaway here. The takeaway here is work implied volatility and consequently Vega into your trading plan and plan around it. Do a spread if you're afraid of volatility falling. Or what if volatility is already really low? Well, if implied volatility is already really low, then that's good. Implied volatility might actually be on your side. And Vega's not a trap, it's a good thing. Also, there are periods, sometimes, or regimes, some people might say, of abnormal volatility. You know, if you go back and look, I mean, I'm giving this presentation live for those of you watching this on recording on YouTube, which Firstrade does a great, excellent job at archiving all their presentations, leaving them on YouTube so people can go back and watch them. But since I'm presenting this live on, what is today, February 3rd of 2026, if you go back like 10 months, almost exactly 10 months, there was that Liberation Day business where the tariffs went into effect and people didn't really know what to think and they freaked out and the market dropped a whole ton and then kind of went rip roaring back. You know, there was like about a 2-week period when it was just sort of market chaos and implied volatility was really high at that time. If you wanted to play the rebound and bought, calls, you would have fell victim to the Vega trap. And that is no good. Yeah, it's no fun finding ending up in that Vega trap. So like if you are going to play the rebound, how do you do it? I mean, for me, the way I did it is, well, at least in my investing, like my IRA, not my trading account, I sold cash secured puts. And you're never going to call the exact bottom, and you don't want to call the exact bottom. You actually want to get assigned on the cash secured puts. You sell them at a super fat implied volatility so that when you get assigned and the option premium goes to zero, you make a ton on Vega slash theta, really, if you want to get technical. So, there's lots of ways to deal with the Vega trap, whether it's a high implied volatility regime, there's earnings. Sometimes implied and historical volatility can be significantly different. If you look at any volatility charts right now, you will find some stocks like that, where implied volatility has just been living above historical volatility for a long period of time. And, when the anticipated directional move is less significant than the anticipated potential volatility move, which is how my earnings trades work. All right, friends, that is everything that I have for you today. I hope this was helpful. I put a lot of time and thought into it, and I think that this is something that's really going to help. Gene says, do you have a range you consider high volatility, such as above 90? Oh, I'm so glad you asked that question, Gene. So here's the weird thing about volatility. It's relative. There are some stocks where 90 might be a low volatility. There are some where 90 is a nosebleed high volatility. You've got to look at volatility, today's implied compared with the implied of the past 6 months. You've got to look at today's implied in the option chain of the option you're considering selling or buying compared to today's historical. And you got to kind of forecast it out. So there's not an absolute value that is considered high or low or whatever. It's all relative. So, all right, friends, have a great rest of your day. You were a great audience. Trade smart, and I will see you next week. Bye.